Hello and welcome to this edition of The Market right here on ET Now. And yes, we're starting off a brand new month. Guys, November is already here, just 2 months, and we'll close down on 2023. But yeah, it seems like we're coming out of the worst month of this year so far. We've retraced from that 19,100 print as of trade yesterday. So just about consolidated in about 0.5% kind of band. The bigger weakness actually pulled down in the last lap of yesterday's trading session, where you did see minor bit of profit booking, especially in the blue chip counters. We'll talk about it in this, just a bit. But the only good thing or the silver lining yesterday was, while the index largely consolidated, that the breadth actually remained to hold out in favor of the advances by a huge margin actually within the liquid F&O universe at least. So yeah. Lots to talk about. Auto sales, earnings still not done, and the November cyclicality.
So Asha, we can find reasons why market should correct. We can talk about geopolitical concerns, Fed movement, we can talk about which way inflation is moving, but the bottom line here is that the markets have hit a pause button. Mid-cap and small-cap stocks have retreated, but there is no major breakdown. So the construct of the market, I think, is very simple, that at higher level, the market is getting jammed. And we are now clearly in a very well-defined range, and that well-defined range may just continue for next couple of weeks or maybe for next couple of days. So I think we must acknowledge that in the near term, given where the global positioning is, where the local positioning is, where the momentum is, the market has hit a pause button. If I'm a bull, I would say that's great news and that's victory for the bulls, because the mid-air turbulence, what we thought, which happened in the month of October, which could have caused some crash landing, that has not happened. But because of that mid-air turbulence, the markets have come down, and then for the markets to gain altitude, well, the weather has to get better or the terrain has to get better. I think it is evident that right now the commitment levels are low. It is evident that nobody is participating. It is evident that right now mid and small cap inertia which was there, that in a sense has retreated. And that is typical of a market. If the market was at 25,000 feet, it has come down to 15,000 feet. And I think it will just stay there for some more time before it gains some degree of altitude. So the mid-air turbulence, what we thought was there in October, all of us thought, okay, it's going to be crash landing. No, that's not happened. Yeah. So if I'm a bull, I would say the setup for me, given what was thrown at us in the month of October, you've so far come on the right side of the trade.
Okay, so perhaps a little bit of consolidation, and that's what we witnessed in the markets in yesterday's trade. Just to wrap up what happened across the globe as well, you do have the Asian markets, which this morning are looking a little bit mixed. You've got the US markets, which did manage to gain traction, ending up by close to 0.5% or so apiece. And then, of course, the Fed concluding its two-day monetary policy meeting later in the day with expectations that they will stand pat on interest rates. All of that is going to weigh on global sentiment. But back home, earnings are on in full throttle. Lots of heavyweights have been declaring their earnings. Among the lot, there's been L&T, and that engineering major did put out a pretty strong set of numbers. You had the overall revenues, which grew 19%. The margins as well normalized in the last 3 quarters. There was an exceptional loss of about 1570 crore rupees, which ate into Bharti Airtel's number. And you had Tata Consumer in the spotlight as well, with the premium brands outperforming the popular economy brands. And then today, Nikunj, a whole host of earnings.
See, if you first look at the big picture from earnings, and I'm just taking the leaf of the Morgan Stanley report, and this is the headline. Q3 September 23 earnings so far, early trends, almost 40% of the universe they cover is out with numbers. Early trends indicate an earnings beat on our analyst estimates. And even though market remained cautious as advised by the share price performance post announcement, we think that this earnings season warrants upgrade, not a downgrade. So for me, that was
not a downgrade. Yeah.
It is not a downgrade, even though the base effect for some of the companies have come in. I can count on my fingertips, barring IT, how many companies have come out with bad set of numbers or poor set of numbers. And I'll have to double count and maybe triple count to look at companies which have beaten estimates or they've given a very rosy commentary. You know, if companies like Blue Star which are consumer facing companies, or Marico, which have gone through a tough time because of what's happening to the FMCG business, if they are giving good guidance, that is then clear indication of which way things are essentially moving, at least for the consumer pack per se. I think Maruti numbers, if you frankly ask me, they were good. Cipla numbers were very good. So there is more earnings beat rather than earnings disappointment. Yeah. Now in terms of specific, Bharti, L&T, and we got numbers from Tata Consumer. None of these numbers are bad or good. I think in the near term, the price target for all these three companies are unlikely to be changed. The dark horse there, I think, is Birla Soft. We'll discuss those numbers when Anisha comes in. And where I think there is a bit of a disappointment, and this is a Rakesh Junwala, backed company, that is Star Health. And it's like saying, even though it's in a health business, giving healthcare to others, the company right now is feeling a bit feverish.
Absolutely.
So that is the way it is. But I just want to go back to the November cyclicality part. I think it's important for us to understand where the November cyclicality part is and what the history has been. 5 out of 10 times in the month of November, markets have given 5 out of 10. It's like even Steven, split right in the middle. 5 out of 10 times markets have gone up, and 5 out of 10 times markets have gone lower. So perhaps there is no trend at play in the large cap stocks. In the mid cap stocks, well, it's more positive than negative. The 10-year average return is 2%. So I will not be surprised that the November cyclicality, which we always talk about, which is more positive than negative for large cap stocks and neutral for large cap stocks, it's neutral for mid cap stocks and more positive, that could be at play. And if you're looking at the near term picture, Aisha, since we didn't talk about it, I thought I'll briefly mention it. Look, we've had a 2-day bounce and we've seen a okay bounce from Thursday's low. So today, because there is a bit of a weak link, will Nifty go back to the lower end of the range or will it stay up? So for me, I think the near term, the test really would be that the recovery, what we've seen in last 2 days, that will sustain. And I think that will sustain because crude is down, volatility is down, FI selling has reduced. So you want to make a case that you want to buy the market if it falls more.
Well, Reliance HDFC Bank couldn't quite do the trick. Maybe it's L&T today, considering strong numbers. Order booking has also been extremely robust. So let's see whether L&T can actually pull up the market sentiment today, although the GIFT Nifty is indicating a bit of a quiet start for us. But that's not it. You'll have your hands full today. You've got the October sales data, which is going to trickle in. You've got tonight the Fed meet outcome. That, of course, is something that we're going to only react to tomorrow morning. But primary market activity as well. Both Cello, Honasa still on.
So, Aisha, it's incredible that one side we are talking about the market hitting some kind of a pause button, but the IPO market is quite vibrant, which means the merchant bankers pretty much know that the activity in the IPO market is something which will keep them afloat. And that also is an indication of that how much merchant bankers are feeling confident of the liquidity, because these IPOs go through when they get some amount of commitment from the IPO, from the merchant bankers and from the investment bankers. The IPO cycle is very short. It's a 3-day cycle. So by the time you start talking about the IPO, the listing actually happens. Now within that, we've discussed, Mama Artha Honasa in terms of where the company is, what a great franchise it is, but what it means for the shareholders. So I don't expect that on a net basis you will get a very large bumper response, at least on Honasa. Of course, the standard guys which anchor investors who got a 5, 6, 7 year view, they would be there. Cello, I think, is a more interesting one purely because of the space which they represents, the brand they have. It's a company which in a sense has diversified very well. The IPO is not very richly priced, but it's a big IPO of about 2,000 crore. So between that, I think the more tilt would be towards Cello world rather than Mamaearth in terms of brand. Cello is a much superior brand in terms of reach and in terms of size. But for me, I think the tone and tonality still is centered around the fact that it's been a bad October, and even though it's been a bad October, just look at two companies. Just look at the IPO market. Every day there is a listing. I think there's a listing today also, right?
Yeah, perhaps it is. Yes, you've got Blue Jet, that is going to be listing today. So clearly, yes, as we've been saying, there's been a lot of fervor within the primary markets, but those were some of the more tracked and more talked about companies. All right, let's move away from that then. Lots going on across the globe with respect to the US Fed decision. What are the global commentators saying? Let's take it across to Vinny to find out just that. Vinny?
Absolutely, that Fed decision will be coming out this week, so that's important to watch out for. We spoke about a lot of commentary coming in yesterday on that, but now what interestingly we're seeing most of the commentary coming in today is mainly on the ECB rate side as well, whether they will be taking a rate hike or what is the discussion point going on around that. So now ECB's Nigel is currently saying that they cannot let up on the rates too soon. Rates will remain high, they could stay high sufficiently for a longer period of time as well, and it's not yet possible to decide for them whether the rates have actually reached the peak level for them. Inflation is quite stubborn is what they're highlighting and hasn't been defeated yet. Yes, so possibility that we could see the rate hikes remain at this level at least for ECB. Now, other than that, similar commentaries coming in from ECB is Kazakhs as well, who's also saying that there's no need to discuss in terms of interest rate cuts as of now. Risk is persistent in terms of the higher inflation is still there for the company, so that is countries, and that is still there. The inflation across the globe, that is still there as well, and that is what they're saying, that ECB's rate cut would need a dramatic turnaround in the economy yet. So yet no decision seems like will be coming in on the rate cut front for ECB as well. Lastly, we have commentary coming in from Bank of France's governor, who's highlighting in terms of the economy of shows that ECB's rate hike pause was fully justified as of now. The confidence patients must now guide monetary policy, and core inflation shows that slowdown shows that monetary policy is actually starting to work. So let's keep an eye out on this commentary mainly coming in on the ECB rate cut, whether they'll pause. There's furthermore, what is the decision to be taken? This is the commentary around that.
All right, thanks very much for giving us all of those details as well as what exactly the global commentary is centered around. Time to chat levels, and let's bring on board Naresh Mirani as well as Soni Patnaik, who's joining in on to discuss the charts. Good to have you both on board. Naresh, let's begin with you then and give us a sense as to what you believe the direction really is going to be this entire month, given that we've already kick-started November. Do you believe that the choppiness, the volatility in the markets is here to stay?
So as of now, the volatility seems to be in a very tight range. So a new range is forming up, which is where 18,850 and 19,300 on the Nifty should act as a zone of consolidation for now. It's only once we start going back above that swing lows of 19,300, we start looking for index to be positive. But at the same time, what is interesting is the fact that the mid cap and the small cap indices do not have the same structure. Same way, there are sectoral indices like autos, which do not have a same structure, or something like CPSC, PSC. And a lot of sectors on the mid cap and the small cap side are doing well. So we are in this consolidation phase wherein we could consolidate on the index as well as on the bank Nifty, but stock specific action should continue on the mid cap, small cap side. On the large cap side, it's time to trade on a lower size given that the trend is not strong. And once we start crossing 19,300, that is the only time one can get more aggressive.
Soni, hi, morning. What's the take on the index and specific stocks like Reliance couldn't quite hold on to its outperformance post its numbers? And L&T, does it seem like it could do the trick for the market today?
Yeah, good morning and thank you for having me on the show. Looking at the broader structure for markets, I feel that we are going to consolidate in a tight range of 18,800 to 19,200 as of now. But the only thing that we need to keep in mind is that FI's positioning in long shorts ratio, they are still very much in net shorts. In fact, they are consolidating and quite stagnant around that 12-13%. So that's a bit of a worry. I feel that, in case we are not able to take out the resistances of 19,300 followed by 19,500, we may see another bit of a sell-off from those levels. So it may trigger, as long as these longs are not converted into 30% longs, we need to stay cautious in the market, especially in indices, which is also backed by, no such leadership taking place by, backed by heavyweight leadership also in the markets. So both Nifty and Bank Nifty, I would carry a sell on rise view until and unless the resistances are taken out. For Bank Nifty, I feel that the resistance is around 43,500 followed by 44,000. So, there are multiple resistances when we talk about Nifty and Bank Nifty. So it looks like more of a consolidation mode for now, perhaps like a week or so. And after that, we may continue with another round of sell-off until and unless the long-short ratio does not improve.
All right, let's nail it down to those individual stock recommendations. Naresh, your top bets?
So looking at first a buy on LIC Housing Finance. The stock has bounced back in the last two sessions, relatively saw a lesser fall. Stock can break out going forward. So a preemptive buy here, stop loss at 450, target price of 490. Second is a buy on CDSL. The stock has given a cup and handle breakout above the 1400, 1420 mark. And the trend is strong across the broking space, exchange space, depository space. So this looks like the next one after BSE to actually break out. Post numbers, the stock saw a positive reaction. Out here, breakout is done, closed done well, volumes also good. Expecting this to slowly and steadily trend up towards 1700, stop loss at 1390.
Sony, let's get your top trades going. What's looking good on the charts this morning? Sony, your top recommendation stocks? I think we...
Yeah, so I'll have two different stocks. So I'll go on a more balanced approach. One would be MCX, which has seen a 20% of long built-up positions yesterday. So it's on the buy side. You can buy MCX with a stop loss of 20 to 70 and targets of 2400 to 2420. The other would be on a sell side, which is Zydus Life. We've seen around 2% or short built up yesterday, and it has been facing a resistance around 585 odd levels. So keeping a stop loss of 590 in futures, you can sell Zydus Life and looking for targets of 560.
Okay, thanks very much for running us through your top recommendations. Let's get a move on then and put the spotlight on stocks that will be tracked today very closely. Anisha Jain with us right here in our studios. Anisha, let's begin by talking about L&T. I think week after week we keep seeing the ticker with new order wins, large order wins. So I guess no surprises that it's been a healthy performance from L&T.
Oh, well, yes, and yesterday itself there was that ultra mega order of over 15,000 crore that they had bagged, and it was showing in the order book as well because that came ahead of estimates. Not just that, the execution also continues to be quite strong. So we saw a revenue jump up of almost 19%, largely in line with what the estimates were on the street. The margins actually dipped a bit. It came in at 11%, but still, as far as the margin picture goes, it's better than what the street was expecting, and that's the reason your profitability is higher by 44%. But more important is, of course, the management commentary, and that continues to be quite strong. In fact, if you go by what Shankaraman was saying, it looks like they're likely to beat their guidance when it comes to the revenue, because they had earlier guided for a 12 to 15% growth on revenue. They are saying that it's likely that they're going to beat it, and ditto can be said for order inflow as well, where the guidance stood at 10 to 12%. Our margins, yes, in the very immediate term, there might be a bit of headwind and the core margin might dip by 50 basis points, but he did allude to the fact that how over the next 3 to 4 years, they're on a margin improvement trajectory and the margins will normalize going forward. They're also talking about a new semiconductor facility that they are looking to put in. So a lot of positive cues coming in from L&T. So let's see how the stock reacts. But Nikunj, you think there is more legs for L&T to gain further?
See, Anisha, we can look at the quarter gone by and talk about, okay, some execution on the domestic side was here and there, and they've trimmed their guidance marginally. But then we are trying to just magnify something which, in a sense, will not really be fair to what the current positioning of L&T is. For me, L&T, it is enjoying the solid tailwind, and all the businesses of L&T right now firing full cylinders. B, it's a company where the return ratios have improved dramatically. From cash flow to buyback, everything what they've done in terms of managing their capital allocation now, I think is fantastic. And what I always look at a company like L&T is that when you're looking at a couple of quarters, then you always look at ROE, and ROE now is at 15.3%, and I think this must be one of the highest ROE for L&T in its history. If I put everything together, the valuations for L&T, and I'm not going to fast forward 3 years forward, I'm only going to FY25. FY25 is just 1.5 quarter away, because we are in November, March FY25 will start. Post December, everybody will start talking about FY25 as the current year. L&T is trading at 25 times. And when I looked at the data, I was like, oh my God, isn't that cheap? For a company which is in a great spot, for a business which is becoming strong, ROA has improved, they've done a buyback, the capital allocation has changed. 25 times when other capital good stocks and other capex stocks and construction stocks are commanding P multiples of 40, 50, 60 times. I think so, A, there is a fundamental arbitrage available. Yeah. B, the tailwind is strong. And I think one should not really read too much into what they miss for the quarter gone by. That is like saying that you'll be, missing the, woods for the trees.
Yeah, and it's the sector leader. The sector is here to stay for the long haul. That's what we've been picking up from all market experts as well. In fact, let's hear out what our Shankaraman as well had to say on the sidelines of the earnings, and then, of course, we'll pick up the second stock with Anisha.
Growth in revenue has slowed down as compared to the past years, largely reflecting the headwinds that is being faced by the sector as a whole. However, looking at the prospects and the pipeline that is building up, we are confident that the company will be able to perform better in the second half of the current year. The growth that is being reported, namely 7% for Q2 and 10% for half year, is led by good performance by the banking financial services vertical as well as the manufacturing verticals of the L&T LTI Mindtree subsidiary, and by transportation and medical devices verticals of L&T Technology Services.
Okay, that's L&T for you. The management commentary as well, by and large, sounding fairly upbeat. Let's move right on then and discuss another set of numbers. And Five-Star Business came out with their earnings, and I think it's been strong performance, Anisha, across their metrics.
It gets a 5-star, I guess, on the rating if you go by the numbers and what the performance has been. And I'm guessing that will be the kind of reaction that we see on the stock as well today. Of course, in terms of the performance, profitability was up 38% on a year-on-year basis. Sequentially, also, there was a jump of almost 9%. The return on asset ratio has now improved to almost 8.6%. And the return on equity, too, is quite strong at 17.2%. That has, of course, been led by the strong NII growth, which has come in at 34%. That's because the AUM has been growing at a very, very fast clip for the company at 45% on a year-on-year basis this time. Having said that, the cost-to-income ratio has inched up, but it's inched up by 75 basis points to 33.5%. Still largely in line to a tad below versus what the management own guidance was. In terms of the asset quality, well, there is no further deterioration as such. If you look at the GNP and NNP ratio, it's actually improved on a sequential basis. The stage 2 assets have actually seen a decline. And the expected credit loss was also largely stable. So nothing as a red flag per se in the numbers, but very strong performance when it comes to the top line growth and the AUM growth. But Nikunj, do you think, when the IPO came, of course, there were questions about the asset quality, but since then the stock has run up quite a bit. Do you think it still can be one of those re-rating and multi-bagger candidates?
Sinisha, they're growing at a rate which is unbelievable. And up until now, there is no evidence of any kind of, NPA concerns. So you are maintaining a growth which is absolutely phenomenal. I mean, you're growing like in fintech. And your NPA management is almost like a private bank. So it's a rare combination to have when a company of that size is growing at that rate with this kind of an NPA. So I think if you look at the headline is great. There are 2 or 3 other factors which I think are important for Five-Star. Five-Star is actually also a PE. There are a lot of large PE ownership in Five-Star. And you know that those PE investors have been selling into Five-Star. And you know that, what's happened with the Sequoia book globally. Could Sequoia's exit into some other businesses? They've already exited some other businesses. Will they exit Five-Star also? Then it is trading at premium valuations. It's not like, Five-Star is available at, 1.5 time book or 2 time book. So premium valuations, premium growth and overhang of some PE investors. Those are the 3 factors which you need to consider. But if you're giving 35% growth guidance and if you're growing at 45% with low NPAs and a lot of visibility in the near to short term, that just clearly means that, they really have a handle over the business. And if you're growing at this kind of a run rate, so then the P multiple will be justified. The risk is that the markets are spoiled now. And they have to maintain this kind of a growth rate to justify this kind of a valuation. A miss here, a miss there, then there is risk to the stock. So to summarize, I think they've surprised everybody. Delightfully, they've surprised everybody. The risk of old investors exiting is a concern which is an overhang and which was an overhang. And C, I think at premium valuations, growth has to be premium. Little bit of slip here or there, little bit of pause here or there, then you get into a mid-air turbulence.
Okay, there you have it. I guess 5 stars for that one. So thanks so much, Anisha, for breaking it all down for us. Well, let's move right on then and put the spotlight on some of the other stocks that will be in the spotlight today.
Yeah, JSW Energy, considering The joint MD Prashant Jain is going to step down with effect from January 31st of next year. Now, with his resignation, he will also be ceasing to be the director of the company. In a statement issued just last evening, he cited personal reasons for an early retirement. Remember, the company has already seen a 25% jump in its revenues and a 2x growth in net income during Jain's 6-year tenure. So let's try and understand how this is going to impact the prospects of JSW Energy going forward. We have with us Rupesh T. Sankhe joining in on the show right now. Rupesh, hi, good morning. Good to have you on the show. Help us understand, what do you think is going to be the impact of Prashant Jain hanging up his boots at JSW Energy?
Yeah, good morning. Definitely, if you look at the last 2 to 3 years, they have entered aggressively on the renewable energy with the acquisition of Maitra, as well as in Bharat. Then we have seen the pump hydro storage, battery storage, then entry into green hydrogen. So a lot of initiative has happened in the last 2 to 3 years. And we have seen market has also given them a better multiple in terms of close to 11 times EV/EBITDA multiple, 25 times PE multiple. So market has rewarded in terms of giving higher market cap from 10,000 crore 3 years back, now close to 60,000 crore market cap. So already market is factoring high growth potential going ahead for next 6 to 7 years. So definitely market will take it negatively, because in such a new verticals, the green transition, you need to understand technology and you need to have a better decision making there. So definitely CEOs, promoters plays a big role in terms of getting market share there and successful entry there. So definitely I think a market will take it slightly negatively, and there could be some execution delays in some of the initiatives like battery storage or pump hydro storage or green hydrogens. So that might be slightly negative for the stock market perspective on a JSW Energy.
There are companies which are built around leaders. For example, just for the benefit of our viewers, the exit of Aditya Puri for HDFC Bank had impact on the near-term outlook. The change of guard at Kotak is something which could have impact on how the leadership would move. Do you think that kind of an association Prashant Jain had with JSW Energy, or he was a professional and there could be a good replacement coming in?
If you look at the last board meeting which happened on 20th October, they have appointed a chief operating officer with a similar kind of role in all the renewable energy verticals. So definitely their new subsidiary JSW Neo, they are kind of getting some IPOs or listing separately. So that kind of valuation will get impact definitely. In terms of near-term potential from the existing operating assets like in Bharat, because of high merchant rates, the already under construction renewable energy assets, we don't see that kind of impact in the near term, and market has already priced in with 11 times kind of EV/EBITDA multiple. From a longer term perspective, definitely I think new verticals like green energy, where a lot of transition is happening, and only few players are entering in this segment. So there, I think we'll have some sort of a negative impact in terms of getting those kind of business vertical and getting better valuation for their new subsidiary. So there could be some negative impact on in terms of getting deals for renewable energy verticals.
All right, thank you so much for taking time out and giving us a sense as to what exactly this change of guard means for JSW Energy. Tell you what, we'll slip into a quick break right here on the show, and stay with us, because on the other side, Sanjeev Bhasin is with us in our studios. So a lot of stocks to be discussed. Don't go anywhere.
Back with the market, right here in ET now. The market construct this morning is not looking all that strong. Of course, we failed to hold on to the rebound that we saw on Friday as well as Monday. Couldn't quite latch on to that. This morning, it's a little bit all over the place. I mean, Asia definitely is holding out, with markets like Japan being an exception. And they, of course, have seen some massive gush of FI inflows. I think within the emerging market, it's only some of the markets which have actually held out, not within emerging markets, within the developed markets, and Japan clearly seems to be that exception there. Of course, you've got the US Fed meet. That's going to be acting as a big talking point, but that's only tomorrow morning. Today, we've got lots of earnings. You've got the monthly sales data. And you've got the IPO market as well, which is pretty lively, with both Cello World as well as Honasa currently on. But let's welcome on board Sanjeev Bhasin from IFL Securities right here in the studio. Sanjeev, good to have you in Mumbai. Welcome back. What's the market construct looking like? I mean, quite the scary October we've had. Will November be any better?
Yeah, good morning. November will be excellent. Now, look, we've had this bout of 6-7 days, which happens once in a blue moon. There was accentuation of a lot of things. But look at the world around you. The Japanese index is 650 points. The yen has hit a new low. And globally, I think most of the bad news is already discounted before the Fed meet. Aisha, on a lighter note, look at the numbers from L&T, the guidance and the order book. Look at Reliance, look at Maruti. I can go on ICICI Bank. So I think the pessimism is overdone. We've had a sweet rally in the last 3 days to recoup some of those losses. There will be the naysayers who will say sell the rallies. But I think this market within a day or so will turn from sell the rally to buy the dip. And that is very much on the cards, purely on the macro basis. 3 years we've had nothing on the index, but earnings have caught up. So now the multiple, even though expensive, is become a tad better. And I think that there will be a lot of, all-round bonhomie with Fed meet, with the Fed meet being a precursor to a lot of money coming back into equities. So I think all the yields, everything is priced in. Geopolitical, oil is down again about $7-8, which again bodes well for India.
Yeah, you picked up on the point on L&T and what a blowout set of numbers, right? And extremely strong in order book. I mean, clearly it's a brainer that it has to be part of one's core holding. But at the current levels, is it a good time to add on to positions on L&T or even buy afresh for those who've not bought L&T till now?
So Aisha, the simple thing is, when you hear the management, they've come out with a buyback at 3,500 or... I mean, the management is extremely bullish. Now, either I trust them or the price. And I would rather trust them. You know, what will happen is, same thing has happened with TCS in the last 5 years. Each time a buyback came, most people tried to be smart and you missed out on a 100% rally in the stock. Because the buyback keeps coming back, but the earnings are catching up. What does a buyback mean? It means the management feels the stock is undervalued to its reality and they can use that cash to buy it back. L&T should be a core holding, whether you buy it at 2,900 or you buy it at 20. There is nothing called timing. So similarly, ICICI, L&T, Reliance, Ultratech, Maruti, these are 5 bonhomie stocks which you must have, and these are declines to buy them.
But Reliance, while that knee-jerk reaction came by after the earnings, and the earnings were largely in line, retail clearly, one of the solid most segments of Reliance, the stock is not all that excited. It wouldn't hold through.
Aisha, I know even I like excitement, but markets are all about patience. Most people undermine that the new generation may not be as what Mukesh is and so on. But that's part and parcel. It takes time. The new generations have a lot of core ideas which are far ahead of the, all the hard work of Jio has been done by both the children. I am not in that camp. I think some of parts Reliance is becoming more and more professionally managed. And like I said, Reliance, ICICI, Ultratech, Maruti and L&T. These are 5 stocks which are going to lead the Nifty. I can bet that this month is going to belong to Reliance.
Okay, that much confidence. What about Bharti Airtel? Because that was a bit disappointing overall when it came to the numbers. There was that exceptional loss as well.
Well, that's more to do with the Africa region where the currency has been. But, on a core holding, you can see all 3 players are doing extremely well. Avan, even Idea, by the way, which I suggested around 8-9 rupees is back to 12. Now, we can keep debating, but I think the company's existence is still there. There is talk of adding the much needed capital infusion. Bharti becomes a pure play because of its other OneWeb and the other things which they've launched. And we know that ARPUs near to 200 are giving a lot of cushion. So definitely you will have to take the numbers with a little bit of pinch of salt because of the one-off on the African side. But I still think Bharti is another stock which should be accumulated.
Autos, of course, will be in the spotlight with auto sales numbers. But what do you like within auto ancillaries, Sanjeev?
So I've liked Motherson Sumi from low levels. I still like Bosch. Only thing is that, you know, the tires or the OEMs and the ancillaries, they have run up also quite in sync with the market. In fact, the auto index is at an all-time high, and these numbers definitely see a lot of some bit of profit booking. But my dark horse play is Ashok Leyland, and I would continue to stick with Bosch. Bosch globally is now arguably in Dresden, the semiconductor plant, the other ancillaries are catching up, and Bosch could come out with very, very stellar numbers.
Okay, Ashok Leyland, Bosch, the two picks from within auto and auto angs. Since we're on the subject of autos, let me take it across to Srishti, find out what the preview for the October sales from Motown is looking like.
Well, yes, October was quite an interesting month for the auto sales data because in the first half of October month, we had the inauspicious period called Shraddh, and then in the second half, we had Navratri and Dussehra picking up, and the sales driving the numbers this time around, wherein festive sales expected to get the cheer back in the two-wheeler segment specifically, as well as passenger vehicle expected to hold that momentum steady, while in the entry level, we have seen the discounts inching up. Firstly, let's talk about the two-wheeler segment then, because we are expecting the return of the entry-level customers this time around. At least this is what dealers are indicating. And all in all, we are expecting a single-digit growth for all the companies right there on a month-on-month basis, from the likes of Hero MotoCorp, Bajaj Auto, TVS Motors, iShares. They are all expected to deliver a single-digit growth on a month-on-month basis. But yearly, if we see, then Hero MotoCorp as well as TVS Motors are expected to show a double-digit growth. Dealers are definitely indicating that there could be a return of the entry-level customers during Navratri. Let's wait by and see that what the numbers are coming in from the retail front. But the inventory build-up is happening from the likes of Hero MotoCorp, which is expecting a robust festive sales this time. Coming to the passenger vehicle segment then, herein M&M, Tata Motors as well as Maruti Suzuki, we are expecting a single-digit growth on a month-on-month basis. The SUVs continue to surpass the record sales data. Other than that, the discounts in the entry-level segment is inching up, and that's why for Maruti Suzuki, what dealers are indicating that the inventory build-up is happening quite at a healthy pace. From the commercial vehicle segment, because September was quite a strong month for all these commercial vehicle companies. So on the back of that, if we compare the numbers on a monthly basis, then yes, there could be a decline in single digit, but on a YOY basis, Tata Motors and Ashok Leyland are expected to show a double-digit growth. For Ashok Leyland specifically, 70,500 is the number what we are expecting, because do remember, for the past 2 to 3 months, Ashok Leyland has been really surprising onto the number front. And lastly, from the tractor division, not much of a commentary from that front, because I believe that the cheer is all about the two-wheeler and passenger vehicle this time around. But the rural sentiment does hold strong, though the festive season retails were quite muted is what the dealers were indicating, and almost a flattish sort of a growth for M&M tractors is what we are expecting. A number close to 45,000 is our expectation, and from the Escorts we are expecting 12,800 units onto the sales data. So let's wait by how the companies panned out and how much festive cheer we get to see for October sales data.
That will be closely eyed. Srishti, thanks so much for giving us those details. Sanjeev, just earlier this morning, we were chatting a little bit about the kind of frenzy that we've seen in some of these defense and railway stocks. What do you believe when it comes to these names? Now, is the trading pop or the ride now already built in, or the positives built in rather?
Well, Avan, that is a glass half full, half empty. If you own them, you are riding your way to the bank. And if you don't own them, the envy is making you feel that they'll come lower and you will buy them. But, I am amazed at the strength in the mid-cap market. Even yesterday, the index, Aisha, was up 0.5%. REC, PFC, NTPC on any decline are buys. Power is going through the roof. And you have the whole ancillary of defense, power, railways, all doing extremely well. So I think ideally, if you bought a basket, you will be in a very sweet spot. But I think the next year itself, till the budget and the elections, belongs to these stocks. So they may have run up a lot, but I still think core holding, these stocks have a lot of potential. It's just the coming of the PSU age, which has not been a laggard for the last 10 years. And there will always be this discount on or debate on whether they are fully priced or they've run up too much. But like I said, it's a glass half full, half empty. If you own them, please stay put. If you don't own them, do a sip and try and add some of the pedigree names.
You know, let's talk about some of those tiny tones and Vodafone idea, Sanjeev. That was clearly one stock that you had identified, and rightly so. It's seen a massive run-up also of late. Now, there are reports indicating that they're looking to sell their Spanish arm. It's a sizable, value that they're looking at, over $5 billion. They are in the need of cash, that we all know. But is Vodafone a long-haul stay?
Well, as a disclosure, we have added those stock. We have some positions. We are very, very optimistic. A stock which is near its 52-week high or near term more than that is definitely seeing some accumulation. Three things have stood out. One, 33% debt conversion into equity for government. AGR recalculation. Three, ARPUs hitting 142, and fourth, their declining trend has now turned into positive on 4G. They are very aggressive as far as capital raising, which is they've said will be done by the end of this quarter, which means 31st December. And any other, asset monetization, Aisha, will go a long way in soothing curves on the debt side. Some of parts at 11 rupees, I think there is possibility of making a 50% gain. And if you have it, then stay with it. If you don't have it, then think of a little bit of a risk to be taken. But I think this can be a dark horse.
Right, okay, that's Vodafone Idea, and that's seen almost a 50% jump up of late. That said, there were others like, some of the HNI dominated names like a Pidilite also, which held out very smartly yesterday. Z bumped up about almost 3.5%. Naresh, if I could just come to you quickly on the charts of PFC, REC, Pidilite, some of the most buoyant names within the broader end of the markets yesterday.
So PFC REC has been a surprise in terms of the smartest recovery they make. So if we look at the stock, it did break down below 240, could only go up till 225. And now the case is we are back to that mark of 250, 55, closer to that, which is where it has topped out for almost 3 to 4 times over the last 2 months. So for now, if it crosses 255, that could be a start of a new trend. Expecting it to pause here around that 250, 55 mark for some time, and then maybe eventually break out. So a new range has formed at 225 to 255 for the stock. 255 could be an important level. Same is the case with REC. Quick recovery, not far away from a all-time high of 297. The stock is just 10 rupees away. If it crosses 300, that would be a fresh breakout for REC as well.
There you have it. That's the view coming in on some of those buzzers in trade. But interesting data, Nikunj, that we've culled out. We've taken 3 different periods of time when the markets have fallen and talk about the collaborating FII selling streak at the time, and what exactly is the data indicative of?
Okay, so let's first establish it. I think we should have gone to the last graphic first, but since we're starting with this, never mind. Every time when foreign institutional investors have sold, and they've sold in a meaningful manner, what has happened to the market after that? And this is a little bit of history. Of course, you cannot relate data in complete totality because that time the question of DI was not there. But in January to 2000 March, massive selling markets. This is that COVID time. So you take that as an exceptional event. But October 2021 to June 2022, market fell when foreign institutional investors were selling. But when that number reached 18%, market rallied by about 18% in the last 5 months. Similarly, in December 2022 to February 2023, markets fell 8% when FIs were selling. But in the next 5 months, the minute the selling stopped, the markets actually rallied by about 13%. Now, let's establish where the current FI ownership right now is, both in terms of the market and also in terms of the positioning. Now, if this again, Morgan Stanley report, domestic institutional investor, because of SIPs, because of new NFOs, their ownership is at 28%. FPI, which is foreign portfolio investor, we call them as FII. So FPI and FI is actually the same. Their ownership is actually at a 10-year low. And the promoter holding is also at an all-time low. This is largely because of the block deals which have happened. But you want to focus on this part, which is that foreign institutional investor ownership has come to a 10-year low. And every time when the ownership has come to a 10-year low, like we said, the market tends to rally after that in next 3 to 6 months, and the average return is anywhere between 10 to about 15%. Now let's look at the pattern here. This is the FI ownership, and that's where financial institutions have moved. So the bottom line here is that every time when financial institutional investors, especially FPIs, have sold, post that number, when the number comes down to, let's say, closer to 20%, markets, they tend to rally. And I think we are nearing there again, which is that every time when the FI ownership has gone below 20% or closer to 20%, the market tends to rally. And I think next time when we are putting out a plate, it really could be October or September 2023 to November 2023 and a rally of 10% after that.
I will hold you to it. Let's see if that actually takes place. But yes, interesting data, Aisha.
Yeah, absolutely. Sanjeev, your take on this? I don't think we really need the FIIs. We can do it alone. The DII participation is good enough.
Correct, and Nikunj has set the cat amongst the pigeon. 21,000 by 31st December, very much on the card. 10% rally, 19,000 plus 2,000 points.
Okay, Sanjeev, we'll hold you to that as well. But good to have you in the studios as always. Glad that you could take time out and join in. Let's also welcome on board Deepan Mehta and chat about what he's making of the market mood right now. Deepan, hi, good morning. At large, one would say in line to good set of numbers, barring a few odd exceptions, and of course the IT sector. L&T firing all guns blazing. What Reliance couldn't do, perhaps L&T can, and see some consistent performance and rub off on the markets, you think?
That's true. I think, first of all, good morning and thank you for having me on your show. Great set of numbers coming through from L&T. And you're right, I think we are a bit early days into the earnings season. So all the good numbers have come through from a lot of the companies. And except for the IT sector, broadly, I think investors' expectations have been met in this particular earnings season. But it may get rough as we go along. So let's just keep our fingers crossed that at least there's nothing untoward from this earnings season which can drag the market lower. And in fact, the earnings season brings out more ideas than ever before, so that investors can focus on those ideas and perhaps take the market out of this range which has been trading in for several weeks.
Deepan, we can find a variety of factors where markets should have gone down, where markets have gone down in the month of October. But if I look at the totality where we are, a 3-4% correction on the small cap index, a 2-3% correction in the for benchmark indices, given what has been thrown at us, geopolitical concerns, raft of FI selling, crude at $90, do you think one should be actually more happy and satisfied with the current market levels rather than worried?
It's a very difficult question to answer because things are just moving a bit too fast, and investors' expectations that we would be over and done with this rate tightening cycle globally, that's not playing out. And frankly, we are in uncharted territory when it comes to the kind of geopolitical events and the interest rate cycle globally. We haven't, at least I haven't seen this kind of tightening of interest rates, and yet the economy doing as well as it is in the US. So I don't know what the outcome is going to be. All I can say is that any further correction in stock prices are a good entry opportunity. And some of the outstanding businesses, which were trading at a very hefty price to earnings multiple, hardly providing any margin of safety, those, if they correct by 15, 20, 30% or so, could make good entry points from a long-term investor's perspective. I really don't understand the global setup the way it is, and why FI selling continues despite India shining and despite so much of positive news flow globally on India. Yet FI selling continues. That's a difficult phenomenon to understand. And yet domestic flows remain extremely strong. So this is the time to focus on individual stocks rather than the market as a whole. I think it will be very difficult to predict which way the Sensex and Nifty are going.
Deepan, you track Reliance and are a shareholder as well. The numbers were in line. Clearly it's retail, which is the most sought after segment within the businesses. But then, the stock is not doing anything beyond that one odd day of an up move.
Yeah, that's right. I think lack of triggers, I would say. And, there is a slight concern about the kind of debt again that the company is piling up. And one thing keeps on nudging us is the low return on capital employed, low return on equity remains around 8% or so. And I think it's been many, many quarters now. We haven't heard anything about reorganization of the businesses, how they're going to get the listed companies, going in terms of Jio and Reliance Retail. Is it going to be a split in the company? Is it going to be an IPO and Reliance becomes a holding company? I think all of these questions remain unanswered, which is why there are no triggers for Reliance Industries. And on the whole, I think company the basic divisions are doing well, and from time to time, they are raising money in Reliance Retail. But as I said, I think the main profits this quarter has come from a cyclical business, and I thought that Jio numbers were slightly below expectation, especially management's call also not to raise ARPUs is a bit, I would say, concerning. So there are certain, I would say, issues coming up as far as Reliance Industry is concerned. And I'm sure the management will address it sooner rather than later.
Nuresh, let's look at a stock which we don't discuss. That's Vodafone Idea. Now we can endlessly talk about, okay, the business is not growing. It's a company which has a large equity base. It's a company where if you are buying telecom, you should stay with Bharti. But the bottom line here is that it has given a 50% return. 50% bhaiya bahut hota hai. 50% return Vodafone.
So technically, if you look at it, the stock chart is actually interesting for a short-term breakout. Now, given that the stock is generally high beta and corrects with the market, it did not correct much over the last 2 months between September to October. The low for the stock has been 10.5. The high has been 12.3. We saw a dip only back to 10.5, did not break the swing lows, whereas majority of the small cap stocks did break their monthly lows. And now we are closer to that 12.3 mark. If it crosses 12.3, that would also be almost a 12 to 18 month high for the stock. And back in 2021 also, apart from a little spike towards 16 odd levels, most of the times it would top out around the 12 mark. So ideally sustaining about 12.35 would be a technical breakout. The relative strength the stock has been showing indicates there could be some positive development also, unless the stock really breaks below 11, and it's a risk reward buy here at current levels.
We've reported. Now, Anurag Joshi, my colleague, reported, I think a week ago, I think last Monday, that Vodafone may get capital infusion. The Birla Group has already indicated that they're raising capital in Grasim via the QIP. And then it's a source-based story that Vodafone may actually get more capital from global family offices. Now, Vodafone India is actually also, a large part is owned by Government of India. So Government of India is not going to bring capital. It's not like they're recapitalizing a bank here. But the two other groups here, which is Vodafone and Idea, if they are able to bring in capital, and Vodafone, by the way, has done some M&A activity globally last couple of days, so they are getting capital back into their balance sheet. So sources have told ET now, source-based story, capital infusion of $1 billion is in the works. When, how, we don't know the timeline, but what sources are telling us that capital infusion into Vodafone Idea actually is coming very, very soon. So Dipen, in this market decline, or in this market shuffle, if I may use, decline is a very strong word. I'm not using, Dipen, by words like decline, crash. I'm simply using words like turbulence and little bit of, stir. In this market, stir and turbulence, where have you actively used declines to your advantage?
Well, you could add one more term to it. It's like a walk in the park correction.
It is, it is, amount of people who are getting worried on social media, the amount of time you meet people and they would say, okay, 2-day correction, game over. I said, bhaiya, aise nahi hota, equity market hai ye. It's like, folks, equity market is like your ECG cardiogram. It will keep on going up and down. What you don't want to see is a flat line. So trust me.
That's nicely put, Nikunj.
Yes,
but coming to your question, I think, which are the sectors or the stocks to look at in this kind of a correction? So first of all, I think consumption-oriented stocks, companies focused on health, hospitality. This is where we're looking at specialty retail. Company like Manyavar, we saw the numbers, which are a bit slightly disappointing because of shift in season. Then Go Fashion, Go Colors, Campus Activewear. These are the company Ethos, where they have had a good beginning. but it has been a soft quarter as far as consumption is concerned. They are reporting slower sales, but I think it's transient. The valuations were extremely rich because the track record was phenomenal, and these are businesses which are very nicely scalable and in a way secular growth stories. So if they're available slightly cheaper and the PEG of less than 2 times or so, those may be good entry points. So we are largely focusing on the consumption pack, be it in the retail side or the hospitality or healthcare. That's where I think the long-term opportunities are. And these companies are very difficult to buy when the markets are really in a bullish zone, because they tend to trade at very fancy price to earnings multiple. And that always, acts as a mental blocker, because you want to buy a business at 70 times, 80 times, 60 times price to earnings multiple. And if these companies are available anywhere from 30, 40, 50 times price to earnings ratio, then they could be good entry points if you have a long-term horizon.
Morning, Dipan. We've been talking quite extensively about the real estate space as well as a whole, the kind of promising opportunity given the fact that there are a few formidable players in New Delhi, Gurgaon, etc. Do you believe that there is a ripe opportunity still at play when it comes to real estate?
I think at corrections, why not? And although a lot of the real estate stocks are quoting at or around their net asset value, the fact is that the opportunities are keeping on growing for the sector and these companies. And I've seen quarter after quarter, because of either joint development agreements or because of price increases or acquisition of land bank, these companies have started to report even higher and higher net asset value or the net realizable value of these companies. So very positive on real estate. Prefer larger companies, especially companies like Godrej Properties, a disclosure we and our clients are invested, probably because of its de-risk business model. It operates in many cities and in many categories. And to an extent, that acts as a good diversity and I would say risk mitigation strategy. But apart from that, I'm very impressed with numbers which came from Oberoi Realty as well. It's a nice focus player, completely debt-free, never got into a problem when the entire industry was under stress. And look at the numbers that they have reported and the way the projects also are selling out, and they're getting higher and higher price realizations as well. So positive on that stock. But as I said, these are not recommendations. Investors should do their own due diligence.
Dipin, I want to go back to L&T, and I look at L&T, I mean, the most widely tracked stock, the first port of call. The minute you think infrastructure, you think, okay, L&T gives you the best play. It's got great IT businesses which are incubated, company buyback, everything what shareholders want. But yet, the P multiple for L&T for FY25 is just 24-25 times. Why is L&T trading so cheap? I mean, it's firing full cylinders. But at a time when other railway stocks are commanding P multiples of 40-50, defense stocks are commanding P multiple of 70-80, L&T is trading at only 25 times.
See, I think these are large companies, and we are in a paradox situation where large cap companies are trading lower price to earnings multiple than small mid cap companies, and that's largely to do with the FII selling. If you see even the banks, that's the same scenario playing out over there. Also the case with L&T and some of the other large cap companies, because I think they are facing relentless FII selling, which is keeping their stock prices pinned down. And so what if it is 24-25 times 26-25 earnings? It's a great buying opportunity, and that would support further appreciation of the stock price. So rather than analyzing why it is available at attractive valuations, I would say that it's a good entry point. Again, a disclosure we and our clients are invested in it. And also, Nikunj, you need to keep in mind that never analyze L&T on a consolidated basis, because the software business and the NBFC will never, you'll never realize that value. L&T is never going to sell off those stakes and unlock value for its shareholders. And those companies are already listed. So I don't want to double count them when I'm doing the valuation calculation for L&T. And if you start to value only the EPC business and the unlisted subsidiaries, then I think it's at slightly reasonable valuation. But the story in L&T is all about, rising order book position. And what has captured investors' imagination is these order flows coming in from West Asia. I think they're very impressive. I haven't seen L&T back such huge orders from the Middle East. And that does open up a new area of opportunity. And most importantly, at that level of operation, at that base level, L&T needs such new opportunities in order to grow at that 15-20% type of top line bottom.
All right, let's also take a look as to what exactly the pre-open rates are likely to be in just about a minute or so. Do remember, we're banking on the fact that it has been a fairly decent wrap-up on Wall Street, and you had the Asian market sort of following cues, but it's been a little bit mixed ahead of that US Fed decision. Dipan, good to have you on board. Thanks so much for joining in. Soni, let me get a take from you then and come in on some of the large cap stocks in trade. What's the outlook when it comes to the likes of Tata Motors? How are you looking at Maruti? Sanjeev was just earlier talking about how a name like Maruti is 100% sure shot in the portfolio.
Yeah, so I think when we look at the auto sector entirely, it has shown good rollovers, specific picks like Tata Motors, Maruti, Bajaj Auto, Hero Motors. They've shown good rollovers. It means that there's a lot of space still left. So I think the best pick right now would be in Tata Motors. It is consolidating rather, in a very good range from 620 to 660 odd levels. It is quite poised for positional targets of 700 plus levels. I think these are the very attractive level to enter. This range is quite nice and it has a very strong support of 600. So as long as 600 is holding, it should move to 700 plus levels. I think it should happen in a month or so. I think this would be one of the best picks. Maruti, of course, it's a good stock pick to have in your portfolios as well. From a strictly trading perspective, I think we should place a bet on Tata Motors and Bajaj Auto for the moment.
Stay on with us, lots more to talk about, but let's put the spotlight on V-Guard as well. V. Ramachandran is the COO now joining in on the show to discuss their quarterly performance. Good to have you on board. To begin with, the company did manage to sustain double-digit growth. So the question is for FY24, do you think that this double-digit growth will continue? Are the demand trends supportive?
I think the demand environment continues to be challenging, right? Particularly for the consumer durable segment or the appliances segment. So I think the retail demand is challenging. I think overall, the B2B type of demand continues to remain strong on the back of, I think, significant investments which are probably happening, in the infrastructure side. But consumer demand is challenging. I think you would have seen the results of a couple of kitchen companies. You would have seen results of some beer companies. I think consumer demand side is a bit stressful. I think we have done all right. I think at an aggregate level, we have grown at about 15%. Some of that is also because of the Sunflame acquisition, Sunflame not being in the past period. But still, I think the underlying growth at about 9%, is more moderate compared to what we would have liked, and this is in some sense, reflecting the underlying weakness in consumer demand.
Could you also share with us that how the demand trend this festive season is so far moved?
So I think one thing that must be borne in mind that the Q2 numbers, particularly I think this is important to consider, for the consumer durable segment. I think a bit of the weakness is also coming because this time the festive period is, the Diwali is coming in November, right? So the entire festive calendar is moved a bit forward. So to some extent, that is also reflected in the September sales, right? So I think last year, second half of September and October would have seen the impact of the festive period, right? Whereas probably this year, it may be, the later part of October and the early part of November. So I think in part, that is also contributing to this, but there is also, some amount of underlying, weakness in consumer demand. So some of it is in the festive period.
So where is it that you're seeing more weakness in terms of which segments?
So I think the electrical side and the electronic side is fine. I think it's more in the consumer durable side, where we are seeing a bit more weakness. On the electrical side, if you look at but there has been some copper prices have come down slightly, so there is some impact on wire sales because of downstocking. So I would say that at an aggregate level, the electronics and electrical demand has been okay. I think it is the consumer durable which is and the kitchen which is impacted because of demand compression. more like fan, water heater, and some of these signs have been visible for a couple of quarters now. So it's not a new phenomena that I'm talking about. It's just that maybe it's reflecting a bit more in the current quarter.
So how is the growth in the rural markets? Are you seeing recovery in any of these markets?
No, I think obviously the premium end of the market is holding out quite all right. I think the pressure is mainly being felt in mid market and in the entry level and probably small town rural. Right? So it's more it's the discretionary consumption which is impacted, and it is impacted more in segments which are what I would say a bit more price sensitive. Whereas when you look at the top end of the market, I think that is holding pretty fine, right? And this is cutting across channel also, right? Even in e-commerce, I think it has been slow till the festive period has started, right? So what I would say the shopping festive period has started, right? So before that, even that segment was under pressure. Yeah.
Right, and finally, you have further increased stake as well in the JSW Energy labs. Will there be further increasing stake, and when will the company start to see the leverage and the benefit of this?
Gigadyne is a next generation battery technology company. It's an R&D company presently, and they're fundamentally, working on developing the battery technology and making it competitive in terms of, relevant performance parameters, right? To make them, first choice for a wide range of applications, because each application has unique needs and characteristics, and also be cost competitive. Yeah? I think the technology has its own advantages, and I think the company. I'm happy to say that the company is progressing. Is on course of creating necessary performance improvements in the battery to make it competitive. This is still work in progress. Yeah. I think we will be ready to leverage this technology for our business benefit only when this technology is ready to be commercialized, which is the next stage of development. I think this startup is now engaged in looking for moving into the next stage, which is manufacturing. Right. So I think commercializing this technology is some time away, maybe another 12 to 24 months. I think it's post that we would be able to leverage this for the Gigadyne business growth.
All right. Thank you so much for taking time out and joining in and giving us that perspective. Let's get a move on then. A quick check-in on the pre-open rates. And for now, just about quiet around the 19,000 mark for the Sensex as well, down by about 43 points. What those top mid-cap calls from our chartist, Naresh?
So continue to maintain hold on Satin Credit Care. The stock is near a breakout. Expecting the whole NBFC space to do well. This is where Satin has also given good volumes in the last two sessions. Stop loss at 230, target price of 270.
All right. And Sony, take us through your top mid-cap call.
I'll have two picks right now. One would be in Apollo Tyres. We've seen long built-up positions yesterday. So we can buy Apollo Tyres with a stop loss of 367 and targets of 395 to 400. And the second pick would be from real estate space, that is Godrej Properties. I think it has been holding quite well above 1600 level as a very strong support. So, you can buy with small stop loss of 1620 and looking for targets of 1700 plus.
Very much for running us through your top recommendations when it comes to the mid caps. Meantime, SML Isuzu, that's going to be in focus today. A block deal is expected to take place. What else is going to keep the stock in the spotlight today? We've got Sharad here with all the D Street cover. Sharad?
Yes, in focus we are having SML Isuzu, and a block deal is expected to happen, and already the due diligence has been done by Ashok Leland and JBM Auto. Now it's said that the promoters will be exiting the company, and already the due diligence is going on for the last 2 to 3 odd months. And importantly, the promoter's stake valued in the company is roughly 44%, and it comes in roughly 878 crore rupees. Now this will be beneficial especially for JVM Auto, because they will be tapping in the extensive coverage network of SML Isuzu in the commercial vehicle space. Now overall, the CV space has seen a very positive commentary from across the value system over the last 2 quarters, and they are expected to be bullish in the coming years as well. Now looking at the stock itself for SML Isuzu, the stock has also doubled from March lows.
Thanks very much, Sharad, for giving us those details. Just a few minutes to go for the market open. So let's revisit it, then the editor's radar. FII selling, remember, has been relentless in the past few months. But data actually suggests that the subsequent months have historically been good for the markets. Here's Nikunj's take.
Every time when foreign institutional investors have sold, and they've sold in a meaningful manner, what has happened to the market after that? And this is a little bit of history. Of course, you cannot relate data in complete totality, because that time the question of DI was not there. But in January to 2000 March, massive selling markets. This is that COVID time, so you take that as an exceptional event. But October 2021 to June 2022, market fell when foreign institutional investors were selling. But when that number reached 18%, market rallied by about 18% in the last 5 months. Similarly, in December 2022 to February 2023, markets fell 8% when FIs were selling. But in the next 5 months, the minute the selling stopped, the markets actually rallied by about 13%. Now let's establish where the current FI ownership right now is, both in terms of the market and also in terms of the positioning. Now, if one, this again, Morgan Stanley report, domestic institutional investor, because of SIPs, because of new NFOs, their ownership is at 28%. FPI, which is foreign portfolio investors, we call them as FII. So FPI and FI is actually the same. Their ownership is actually at a 10-year low. And the promoter holding is also at an all-time low. This is largely because of the block deals which have happened. But you want to focus on this part, which is that foreign institutional investor ownership has come to a 10-year low. And every time when the ownership has come to a 10-year low, like we said, the market tends to rally after that in next 3 to 6 months, and the average return is anywhere between 10 to about 15%. Now let's look at the pattern here. This is the FI ownership, and that's where financial institutions have moved. So the bottom line here is that every time when financial institutional investors, especially FPIs, have sold, post that number, when the number comes down to, let's say, closer to 20%, markets, they tend to rally. And I think we are nearing there again, which is that every time when the FI ownership has gone below 20% or closer to 20%, the market tends to rally. And I think next time when we are putting out a plate, it really could be October or September 2023 to November 2023, and a rally of 10% after that.
I will hold you to it. Let's see if that actually takes place.
Okay, let's come down not just to the market open, but tell you what our chartists are recommending by way of index calls. So the 2 day of a rebound, it didn't quite hold on. Let's see what Naresh is recommending. He's recommending a no trade on the index right now. Sony's actually calling it a sell on rise, and it's a hold from Santosh Meena. So not quite the consensus this morning at all. Similar is the call on the Nifty Bank as well. Naresh is recommending not trading the Nifty Bank at all. Sony recommends a sell, and it's a hold from Santosh.
Naresh, will we see a breakout or a breakdown before Diwali? What's a Diwali trade? Maal lene ka ya maal bechne ka?
So the trade is to be stock specific. Index doesn't look like we are going to break out 19,300, 400 or break 18,850 as of now, unless something changes globally in a major manner. We've seen a good enough decline across the world, but we've not seen a similar decline here. So US indices are down 8 to 9% from the top. We've not taken a similar hit. So just outperforming by not falling as much. So the trade is to go stock specific on the mid cap and the small cap side. That is where the recovery has been faster.
Okay. Sony, what's your sense? I mean, is there a long trade before Diwali or a short trade before Diwali or no trade? That third option is also there.
Right. So, Nikunj, I feel that it would be a short trade, for two parameters alone. We've seen shorts getting rolled over from October to November series. So I think that's something that's going to hold in the second half of of November series, especially. And as long as FIs are not converting their net shorts into net longs, I think it would become a sell on rise market. We may even breach 18,800 levels this expiry. So it's better to trade with cautious, a lot of cautious trades, or perhaps hedge the positions as, one trades in indices.
All right, 45 seconds to go. And the first rates on a day when markets will be reacting to L&T, markets will be reacting to numbers from Bharti and Tata Consumer. The net numbers have been strong, and Bajaj Auto as always just before the market. October sales 4.71. I don't remember the estimates offhand, so I will not say anything. But 4.71. I don't have the versus figures, so I don't comment on it, and I don't remember it. I'll be honest. It's going to be, but the month of October would be an important month for the entire two-wheeler space. Why? Because you will get a sense of Dussehra and you will get a sense of Diwali. So the poll was 4.1. And what they've done is 4.7. Wow. 60,000 more. That's like a 15% beat. That's excellent. Okay, we'll talk about Bajaj Auto, but right now let me just capture the market. And the market rates are Wednesday morning, brand new month and a brand new day. But it's the status quo in terms of trend. The breadth is powerful. Small and mid-cap indices are off to a good start, and Bajaj Auto, is it immediately reacting to the numbers? Let's capture that. Of course it is, and it will. It is, and it will more, because these are bravo set of numbers. Now these are numbers which are the company dispatch. So is the company building up inventory in anticipation of a strong festival season demand? That's one. Or B, there is an extraordinary uptick which has come in largely because of some sudden demand which has come somewhere. I don't know. We'll try and get details, but right now markets are reacting to those numbers. Meanwhile, just when we thought that markets will be off for a flat start, comes the selling. The breadth is holding on, but what has gone down in the Nifty? Let's look at it actually. I think it's L&T, it would be Reliance, it would be HDFC Bank, the combination of typical IT and heavyweights which really is leading the market. So Reliance is down, HDFC Bank is not going anywhere, ICICI Bank is not going anywhere, and banks is this, cross. I mean, it is like it's like a mill in the neck of the bulls, that you cannot run and you cannot walk with this FI selling in the financials, and that in a sense is the real impediment for the bulls to really launch any kind of an attack. But so far, market breadth is holding on, and the benchmark indices are trading with a narrow negative bias.
Bharti and L&T, those are the two stocks that you may want to look out for given the earnings reaction. Of course, it's been an above estimate on all parameters. Management pretty optimistic on the guidance. Order inflow for L&T, 1.6% higher for L&T as we speak. And Bharti is the one which will come up for you on your screens, because that's where the disappointment has been. 1.7% lower. It's almost a seesaw of sorts between L&T and Bharti this morning. Tata Consumer as well has been a good set. The numbers are above estimates on all counts. Lupin, they received an EIR from US FDA for their manufacturing unit 2 in Mandideep. Lupin holding up 1% as we speak. Ather has come out with decent numbers. The profits have risen almost about 35%. That will just come up for you on your screens. Motherson Wiring, the EBITDA jump up of 37%. Ather has gapped up 4%. Motherson Sumi Wiring 2.5% higher. CE Infosystems has come out with its numbers. Thyrocare Tech is come out with its numbers. There's been a decent margin expansion to 25.3%. MRPL, wherein there is EBITDA jump up of about almost 3.5% there. This KEI Industries, EBITDA up 27%, margins at 10.5%. So all these stocks are reacting positively to their numbers. What is JSW Energy up to, considering Prashad Jain has stepped down as the joint MD and CEO of the company with effect from Jan 31st next year? Not a big knee-jerk reaction, 1% low on JSW Energy. In fact, it's only strengthening from there, rebounding from there. Mankind came out with its numbers. The margins are flat on a sequential basis, and the revenues have seen an uptick of 11.6%. A big gap down on that stock to begin with, 3.5% lower. GSPL also came out with its numbers. The numbers fell short of market expectations. The standalone EBITDA per ton is below the estimate estimates. It's come in at 11,164 per ton. Jindal Steel is seeing JSW Steel, JSPL, I beg your pardon, that's down about almost 5% as we speak right now. DCB also came out with its numbers. Asset quality has deteriorated. There's Gains Technology as well. Gross margins contracted 200 basis points. And then Star Health, wherein the net premium earned was up about 15%. And the combined ratio has risen 130 basis points, but that's not quite on course with what the market was anticipating. Star Health down 1.5% as we speak right now. Other disappointments have been Dhampur Sugar. The EBITDA is down significantly, almost 29%, and Naveen Fluorine as well, wherein the EBITDA margins is the lowest in about 18 quarters. Naresh, what's